Hello everyone, Shaun here this week. I think Jeremy's at the Grand Prix, so just got me. Welcome to the this week's hangout. Just going to start off with a little disclaimer. So give this a little bit of a read while I'm just giving a synopsis of what's been happening. We're coming into the end of the month and the end of the quarter, which for us is particularly important. We only get, obviously, this opportunity 4 times a year. So effectively, a lot of the studies and methodologies and limits of range and all those sorts of things, they all reset at the end of this week coming. And it opens up lots of opportunities. So it's going to be unlikely that there'll be any new positions going on ahead of that unless something comes out quite compelling. Having said that, for the first time really this year, we've actually had the first signs of a change in trend in stocks, but not on all of them. So for those of you who've been on the Facebook inner circle, would have seen some things through the week suggesting that there was a few things changing. And the main takeaway was the fact that in the sector rotation, so what I call pass the parcel, or the endless merry-go-round, what becomes fashionable eventually becomes unfashionable. And we saw that this week. Have to be very, very patient. It's one thing knowing that something is in a process of topping out, or something's in the process of bottoming out. But you still got to get your timing right, unless you've got very, very deep pockets. So we're going to have a look at what were financials, so banks, have a look at what some of those stocks did, I think, and also look at some of the main markets themselves. So it's going to start off, if I go into my CQG, just going to make sure I am screen sharing. There we go. Right. Okay. So I am finally share screening now. There's a little bit of a disclaimer there. So just give that a little bit of a read. And the people who are new, just a little bit of background. Jeremy has been trading for about 15 to 20 years, an expert in a very specialised market, as it were, the Australian power market. Made hundreds of millions of dollars over the years, and as he's not on air, I can sort of like say that he's picked up the best part of 200 million this year, which just goes to show when the markets play, when they really trend, there's some serious money to be made. So he's involved in that. Came to me 5 or 6 years ago, and I became his mentor, and he embraced some of the creations that I'd made from the book Trading Time, published in 2007, and was sufficiently enthused that he created some of his own stuff, or revisualized some of the things that I created. And since then, we've been working together, made some new studies and new visualizations of what already existed. The idea being that you can look at any market, doesn't matter what it is, and you see everything you need to see just in one picture. Professional traders, whoever they are, they quite often spend a lot of time just looking at lots of screens and lots of charts, and you get some confusion about, what one should you really be concentrating on. And so my thesis was that to create that visualization in one picture was essential. It means that you can look at a lot more markets, you can scan for a lot more markets, and you really don't care what's at the top of the chart. It's just looking for opportunity and setups. I've been trading since 1979, started at 16, done all asset classes, wrote commentaries, written books, many mentored professional traders for 20 years and run various private funds over the years in different asset classes. The last one that I did was in stocks, which led to some of the creations that you now see today. So we're going to go into some charts. Talked about a sea change, and first of all I'm going to call up the S&P. What study we've got here is what's called range relativity. Lots of lines, as you can see. What we're interested in, if I just spread this out a little bit, is we have multiple time frame range deviation pivots all the way up to annual levels, and we've got those black lines there, so you can see one's above and below, and they reset every week. And what I want you to really concentrate on, if I was to scroll all the way back to November and the infamous night of Mr. Trump, you see that we came down to the pink line, which is the quarterly limit of range. We hit there. It was also the monthly as well, which is the blue line. And since then, we've flirted with it occasionally, but we've never actually really managed to close below the bottom pivot. And the week just gone is the first time that we've managed to do that. So that is a change in trend. It means if you were long on your general portfolio or long the market, then you no longer have permission to be long. It's a call to action to say that I'm going to head for the hills, taken a very nice profit, and we wait for it to reset. Because it's coming to the end of the month and the quarter, we're not necessarily interested in getting short. We want to see what happens over the coming week. I think the other thing that's really important, we put something out on the inner circle, was we broke the line, I think it was on Tuesday, but then we came back to it. So the level becomes a resistance point, and we failed there. I think it was the following day. It was also on a peak energy and peak expansion, had a very similar level, which was 23.55. That's effectively where we've topped out. If we look at some of the other markets, so this is the Dow, done the same thing. So went below it, came back up, failed. That was the Dow future. If I do the Dow cash, exactly the same. Yeah, so it's gone below that weekly line. The thing that also shows up is that we were getting very, very close to the annual target, which is that red line. So we've talked about the market being stretched and was beginning to get tired. We've talked about that for the last 2 or 3 weeks. It was beginning to get tired, and then that's also broken down. The only problem we really got is the NASDAQ. And the NASDAQ went below it temporarily, but it didn't close below it. So we haven't got like a confluence of all the aspects of the market. The NASDAQ's been the strongest element of the American market, and that one hasn't broken down. So what's going to happen tomorrow when it opens is we're going to get a new set of weekly levels, and we'll be referencing that and seeing what happens. The other thing is looking at other markets around the world. On Tuesday, we put out a sell signal on the FTSE, which is the UK market, and we came off, and we just closed below it. However, somewhat surprisingly, when I called this up yesterday, I go to the European market, so this is the DAX. We very briefly went below it, but we've actually closed pretty near the highs, and it's the same for the Euro stocks, which is a more general index of European indexes or European stocks. It's done the same thing. So what is surprising about that is quite often what you would expect is the euro, which has been going up this week, so the dollar's been quite weak. That's normally a negative for European stocks. So it's sort of bucked the trend, as it were, and was surprisingly resilient. So we haven't got complete confluence. One thing about trading safely is we can afford to be patient. We don't have to be diving in as soon as we see something. So ideally, we'd like to see everything confirming and saying that the market has made a high if only an intermediate high, and we're in for some corrective phase. One of the things that I suppose concerns me is the fact that everybody in the professional world thinks the market's overvalued. I mean, they have done for a while. You know, lots of stories. You know, we had a big down day on Tuesday, and suddenly there's loads of stories on Bloomberg about how fund managers think it's the most overvalued market in this century or last century or whatever. That sort of concerns me. The reason why they're saying that is because a lot of them are not long enough, and so they've missed a lot of the moves. So I certainly don't think that we're heading for any sort of crash or anything like that. You get a lot of doom mongers out there saying that sort of thing. The ideal scenario is we do get a corrective phase, a decent one, and that's an opportunity to buy. Now, within our analysis, talk about sectors and what's number one of number one. And it might be a little bit difficult to see this screen, and this is how I actually screen sectors. And last week we talked about semiconductors, which out of nowhere have suddenly gone to number one. So unfortunately I can't change the font of this, but it's number one last week and it's number one this week. And the other thing that's really changed is telecom and fiber optics, which has soared to number 2 from being number 16 just a week ago. And the banks, just going to change this screen and just put it back in. Banks, which was number 1 and had been for quite a long time, is now at number 3. Now, the market itself, I think it went down about 1%. I'm just going to show you what some of these banks did and some of the indexes as well. Now, the first thing, when we talked last week, just going to do the S&P. Spread this out a little bit. There we go. Right, so we have lots of lines. I'll just remove the range relativity. We don't need that. There we go. A little bit clearer. And the thing that happened was we have these red lines here, which is daily lines, which is what the professional world uses on trading safely. You do have the option to put them on, but we like to try and keep it a little bit simpler, so you just have weeklies and monthlies. But they went to the top of the market, and this black line is the weekly line, and that also went to the top of the market. And this is a key thing about timing. We can get sell signals, we can say it's overstretched, but what we need the market to do is build resistance based on its own momentum. Absolute critical factor. And then that enables us and gives us permission to get short if we want to, or certainly get out of any longs. So what happened was this weekly line, this black line, moved to the top, and suddenly it opens up the downside. And we had this blue square is what's called a slam dunk signal. And we had that on the market itself. On the NASDAQ, it's slightly different, but very, very important. We have this pink line. This pink line's been there for a very, very long time. That's been going horizontal since January last year, actually. And this is peak expansion based on Henk and Ashi charts. So it's a different visualization of data. It means the high lows are different. At some point, we'll probably do a session on Henk and Ashi and show the reasons why we use it. But that moved to the top on Friday, because from the peak point was confirmed. And so that's the first sign that the NASDAQ can build resistance based on its own momentum. Now, one of the things that's probably going to happen, unless we make new highs in the coming week, then the likelihood is this black line, which is the weekly, is also going to move to the top. So there's a proactive nature of the studies in that we sort of know what they're likely to do. So this will coincide with the end of the month, the end of the quarter, and provide a timing point, and then we'll be looking at opportunities to get short. I'm going to go through some of the banks now. The market went down 1%. I got a few on the professional commentary or coming back to me saying, oh, you know, here comes the, you know, here it goes, we're all going to have a massive correction and all the rest of it. But remember, we actually simply fell 1%. However, what is fashionable becomes unfashionable, and financials, which have been the #1 sector out of the 197, suddenly became unfashionable, and that's actually what drove the market down. And the #1 stock of the #1 sector was SVB Financial, and that stock actually dropped about 11%. So while the market was only down 1, the most fashionable sector dropped, and the stocks within it dropped anything between 6 and about 13%. And so there was a lot more money to be made by being focused and in the correct place to be short, which has definitely been banks. And if I do some of the other stocks, BBT, for example, see that if you'd have bought this stock any time in the last 3 months, really since, well, 4 months almost, it's taken all of that out in just about 1 week. Yeah. So very, very, a very steep slide. And we had slam dunks generally at the top of the market. There's a few things about what makes a sector top out. Yeah, so it leads the market, it's #1 of #1, everything's wonderful. And then what happens is you start to see chinks in the armor. And the first one that we talked about was probably about 6 weeks ago, which was earnings season. And I said at that time, I said, well, it probably doesn't matter what the earnings are, because it's such a crowded trade that everyone's already long, that even if the results are good, it doesn't necessarily mean that stocks are going to go up. And we had some instances of that. This is FITB on a daily chart. You see that little blue cross? That is a slam dunk signal if you're looking on the Chart IQ software. I'm just going to show you Goldman Sachs, big bellwether bank, and where I've drawn that little circle there, that's when their earnings came out. Now, their earnings actually beat, they've done really well, and the stock went down. What we call good news, bad actions. That was the first chink in the armor. The breakout, the original bullishness, came with a power play signal, which is the opposite of slam dunk, which is that green square, and it broke the final monthly resistance, and away we went. Now, we made new highs, we edged a little bit higher, and then what happened was this gap, which is slightly unusual. There's a price gap there from there to there, and this was again to do with Trump. I think he said something about his, I think it was when he was talking to Congress or House of Representatives, something about his budget, and banks all went higher. Then last week, so we gapped higher and then immediately went back the other way, and we got a lot of slam dunk signals. And then last week, we had an interest rate rise, widely expected. I don't think they really said anything that wasn't what the market thought. But banks went down. Now, normally interest rates going up is good for banks. So again, we're getting good news, bad action. It was probably already in the price. And then suddenly, all the momentum is lost. You know, everyone's long. And then suddenly on Tuesday, everyone heads for the exit at the same time. So we actually got another slam dunk signal here. And Goldman Sachs is interesting because it went directly to its key weekly support, pretty much to the tick. I think a couple of cents below, and has stabilized for now. So banks generally dropped about 10% pretty quickly. You get a very fast bang for your buck. And some of them, we're now looking at those key support points, and if they break them, then we can open up the downside even more, all the way down to 186 in Goldman Sachs instance. And if I put the range relativity on, closed way below the weekly line, and we also are below the monthly line, which is the blue one, and we've got a quarterly that's going to reset at the end of the week. All right. So that's banks. The other one that's been on our hit list has been airlines. And again, 2 weeks ago, I think it was, during the week on the Facebook Inner Circle, We had a day where, actually I'm going to show you oil first. Let me just do oil. So we had the price of oil. Obvious correlation between airlines and oil. Represents probably a quarter or a third of their costs. And we broke a weekly support. This line here, it broke it and closed way below it, and we've extended down, and we've got close to a weekly target of 46.53. We stopped about $1 short of that. Now you would have thought that oil going down would be beneficial for stocks, or airline stocks, and we had a day, you can see it's the same day, so oil went down, and so did, this is Continental Airlines, so did the airline stock, and it broke a support point, and we flagged that up. Airlines have been in the top 10 of sectors, and considering that the price of oil is relatively, well, pretty much at a 2 or 3 year high, that didn't really make a lot of sense as far as we were concerned. And so being short airline stocks was another one that was a favoured trade. It was also, for whatever reason, quite often pumped in the media. They'll remain nameless, but some of you in the inner circle will know who I'm talking about. Mercilessly pumped airline stocks, saying that they were a great thing, and actually it didn't necessarily make a lot of sense. So airline stocks have been pretty poor. They're down 12 to 15%, so they've actually fallen more than what the financial ones has. This is Delta Airlines. Again, you can see where it broke the support point, and we've edged lower since then. So that one's down about 14%. So they're the two sectors that we wanted to sell, and what is fashionable becomes unfashionable, and what is unfashionable becomes fashionable. And the number 196, if I just go into my sector list and switch it around the other way, I think it's 196, yes. Oh no, it's moved up a little bit. 193, apparel, clothing. Yeah. Now, I can tell you now that about a year ago, this sector was number 1. Are we all buying less clothes? Are we all buying less sneakers? I don't know. Of course we're not. So what makes something go from number 1 to 193? Well, it just becomes unfashionable. Market decides it doesn't like it, and it's been punished. And so we're looking at the individual stocks, of which there's 28 of them within that sector, to see whether anything's getting interesting. And there is a few that are, and we'll be very interested in them in the weeks to come. I think the other thing to note when we talk about sectors, the way that these things are measured is not just the price action. It's like all the fundamentals and how much they earn and sales growth and blah, 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 all sorts of things. And apparel as a sector is only down 5% this year, whereas something like retail office supplies is down 21. And if I inverse this and look at what's at the top, financials are actually pretty much flat on the year. So the measurement of how they're valued is very, very high, but actually the price action is not reflecting that at all. In fact, it's actually slightly down this year. Whereas if you look at telecoms, which is just one place higher at number 2, that's up 18% on the year, as is semiconductors. So just because everyone thinks it's strong on a fundamental or a economic measurements doesn't necessarily translate into the price. So apparel and clothing is one that we're interested in, and the reason why it was up this week as a sector was PVH, which I think they do Tommy Hilfiger. So they have stores worldwide. Their results came out, gapped higher, and they sort of dragged the whole of apparel higher with it, and it's opened up some space all the way up to 115. We did have a buy signal back in February, but it wasn't at support. Note how support then formed. And if I do COH, which makes handbags, I think leather goods, this was one, probably we missed the boat there a little bit. We did actually get a buy signal again at a similar time, but it was close to the monthly support. It was a little bit too far away to activate a trading safety signal. And this stock has been edging higher anyway. And also note, in what was generally a poor week for the market, this stock was pretty much unchanged. Yeah? So we're seeing some strength in apparel and clothing. There's about 34 stocks there, and we'll be looking for some opportunities to get long. So that's the stocks. I'm just going to see if there was anything else off the top of my head that was interesting. Yes, there was. Pharmaceuticals. Now, we don't trade pharmaceuticals or individual biotech or pharmaceutical stocks because they're subject to price shocks. You know, a drug test goes well, it goes badly, stock can go up gap 30-40% easily. Or sometimes they are quite known for cooking the books, and suddenly, so you can get these big shocks. However, you do have permission to trade ETFs because it's going to smooth it out a little bit. And what we talked about was two main biotech ETFs. This one is XHB, and this had broken a weekly resistance line. You can see it topped out here, came back down again. We'd had a buy signal at the monthly support, had a power play signal back in November, and it's sort of broken up. But the other ETF, which is IBB, hadn't confirmed. You can see that that's failed at its final monthly resistance, and we've had a few sell signals come through. It actually looks pretty poor, and if I put the range relativity on it, it didn't quite close below the weekly level, so it was pretty close. If we'd closed below the semi-annual, the brown line, then we could really open up some downside. So just about hanging in there, but we did get one call to action this week, which is massive biotech stock that actually sells something and actually makes money. And you can see that that went to its final monthly resistance, the blue line, and we had a UFO signal. So the UFO came up. So there was an opportunity to sell that individual stock. It stopped at its weekly support for now, but it's very easy to know where you're wrong. The other one that taking some instance on is house builders. There's been some statistics on house builders being the most optimistic that they've ever been or something. You can go to zerohedge.com. They're always doom and gloom, so I wouldn't read too much into it, but they do have some interesting articles from time to time, of which that was one of them. And it sort of stalled. Ideally, what I would have liked to see is it to get all the way up to that final monthly level and then look for opportunities to get short. So watching house builders, purely because it seems to be a pretty crowded trade. Everyone's very enthusiastic about it. Right, so what we're going to do now is just look at the overall markets and see where we are. So I'm just going to reiterate the American stock markets, show you where we are. Look at all these supports. So these have stayed here for months now. So there's a massive area of support down here. It's a long, long way away. Best part of 2,000 points. That's our ideal scenario on a market correction, as it comes down into this area and then we get some buy signals. In the meantime, we have had a triple sell on Tuesday, and what that is, that's a combination of step theory, which is the diamond, a slam dunk, and a divergent signal based on the stochastic. So in the short term, we've got some negativity there. It's the same on the E-mini, and as long as you can see here, a lot of things that were below price on a daily basis, these are all daily levels, these red and pinks, they've all moved to the top, and then also the weekly, which is the black line, has also moved to the top. And what was support has gone to resistance. So there really isn't any permission to be long anymore. That trade is over. And you can see that there's a little minor resistance point, which combined with the range relativity level, and we've closed below it. So E-mini is negative. Nasdaq, again, just daily levels moving to the top, but not as negative as anything else. So we're going to go on to currencies. You would normally, the perception would be interest rates up, currency up. Of course, we know that markets are not logical, and so we had an interest rate rise, widely expected, and the dollar index collapsed. Yeah, so who knows why? Really just to muck everybody up. However, we have now come down and we've stopped just short of a weekly support point. So there was room for it to fall. We had this space here, but now it's come down to a support area and it's stabilized. We have to get below 98.53, which is a monthly support, which has been there for a very, very long time. Look how far this line goes back. Yeah, way back to November 2015. So that's a real critical point. A little bit like the Dow levels. The ideal scenario, as long as we're above that line, we are still in a major uptrend. Then you want it to come down to there and produce some buy signals and say that the dollar's going to restart its trend. Euro has a very heavy weighting to the dollar index. I think it's about 50%. So the dollar index sort of disproportionately moves based on the euro as opposed to other currencies. And we had a buy signal down at a daily support a few weeks ago, and we're sort of in the middle of nowhere, really. We can get up to 109.72, which is a weekly resistance. We also have a very, very big level here at 110.82. Got to remember that euro is always a crowded short. Everyone's negative as the euro, especially if you're unfortunate enough to live in Europe, because the project's doomed. And so it's always a crowded trade being short the euro. It's very easy to just have a view that says, yeah, the euro's going down. I'm only ever interested in selling the euro when it's strong. Never, ever sell weakness in it. Go to the pound. The pound, we did get a buy a few weeks ago. I sort of didn't action on it. I probably should have done. Living in England, I'm probably a little bit too close to it, and we get endless stories about Brexit, which is becoming almost as tedious as the credit crunch. So somebody says something about Brexit, and they say something else about Brexit, and we go up, down, and it's all very, very boring. But we did get a sell signal on Friday, but not at resistance. Yeah, so again, not actionable. So the pound is slightly negative. The Australian dollar is something where we've been talking about a lot, and this was also we got overextended on the range relativity. And we'd previously come up to the monthly and weekly resistances. We came back down to the monthly a couple of weeks ago. Then we've gone back up again. And we closed below the weekly level. So we had a sell signal on Tuesday. It was a UFO. And we've come back down, and we've got this level here around 75.67. So negative of the Australian dollar in the short term. Going to go on to gold. And gold was overdone on a range relativity basis at the end of the year. I just put that on. So yeah, we'd gone below the monthly over here, and then snapped back and got the buy signal. And then what's happened in the past week, if I just remove that, is we've come back to this weekly level. And we had a timing minor sell signal. That's just a timing point. It's to do with the 7-day rule, 7-week rule, 7-month rule. So that's what that arrow is there. You have to say that compared to what the dollar has done, which has been pretty weak all week. There we go. Gold's sort of underperformed a little bit. To remind you on crude oil, big level down here. 46.53. The inner circle, we had I put out a report on. I put out a report on Thursday. So it's just the finding a base on oil. So you can see that on our inner circle where it's all gone through. And there are some calls to action in the stocks that we're looking at. So I'm just going to briefly show you those. And the first one we have is HP, which is Helmerich and Payne. And the thing that I'm really interested here, and the thing that I like about it, is this red line has appeared, and this is the annual range relativity level. So it's not showing all the weeklies and monthlies. I've just split it up a little bit. We've got a weekly support, which is this black line. Then we've got the annual target, and we've got the monthly support. So a few, about 5 to 10% lower from where we are now. So I'm really, really interested in that. We've got a confirmation of an annual target with a major monthly support. So that's on our watch list. Then we have this one, BPT, which is a royalty trust. So they, I don't know, they sort of own some of the wells or whatever. It's in Alaska. It's part of BP. And this one is very interesting because it's actually already broken out. Got hit with a slam dunk and broke support a few weeks ago, and then it's come down into this area. So we had 2 black lines, so 2 weekly lines, which go a long way back. You'd have to go a long way back. So the market doesn't know anything about these levels. I always really like weekly or monthly levels that are created not at absolute high lows. That's the perfect scenario, and also they've been there for a very long time, because it means the market doesn't know anything about them. Market's come down there. It went into the semi-annual level, and we've now broken back out the top. So if oil breaks down and goes to that next downside target, the ideal scenario is we come down to here, which is the monthly, and the annual, which is creating a zone. Next one is, I think, the biggest oil company in the world, I think. ExxonMobil, XOM. Now this has broken its monthly level, yeah? This blue line, it's a bit difficult to see there. It's also semi-annual, but it's gone down to the annual line and held. So it's sort of trapped. It's trapped between these 2 points. Really looking for this to then break out back out the top towards the end of next week or the following week and open up the upside again. A very, very close correlation to oil, not surprisingly, although in the past year or so, when oil has rallied, mobiles tended to outperform. Next one is another big one, Marathon Oil, MRO. You can see this big zone down here. Very, very powerful. So we've got a monthly level, a weekly level, a semi-annual, and an annual, all within about a buck of each other. It's got to fall a fair way to get there, but we're very, very interested in that one. I think there is just one more. Oh, the ETF, yep, not a stock. So if you just want to have a general exposure to oil, there's a lot of ETF sets actually out there. I did go through all of them, and this one was the one that was the most interesting, which is one of the biggest anyway. So this is the Spider Oil and Gas ETF. So it's got a bit of both in there, and we've got this monthly support. There is no range relativity levels. If I just call it up, we've stopped at the monthly, on cue, as it were. But of course, that's going to reset in a week's time, so that level's not going to be there anymore. So we'll have to see what the new levels create. But we've got this major monthly support, which is not too far away. Right, I think, how long have we been going? 40 minutes, so it's probably long enough. I'm just going to check if there's anyone put any chat in there. Nope, nobody's asked any questions. So we are gonna be changing the format a little bit in the, I think next week and the week after. There's never a good time zone for everybody. You know, it's Jeremy's Sunday night. It's my first thing Sunday morning, and I was out going to a concert last night, so I can get into about 2 in the morning. Good bit of punk rock from the Strangers and the Ruts, and of course in America it's it's the middle of the night, Saturday night. So we are going to change the time that we're doing it. We're probably going to start doing on a Tuesday. Which will be I think Wednesday morning Australian time, my Tuesday evening, probably about 10 o'clock at night, something like that, and the American afternoon. One of the reasons for changing, trying to get more people live so we get more questions instead of dealing with it on the Inner Circle Facebook. Also, we're very big on weekly levels, monthly levels, etc., and so it's quite nice to see what the new levels are for the week that obviously come out on a Monday, and so we have some fresh reference points, so we can be a little bit more proactive by doing it on a Tuesday. I'm trying to think if I've forgotten everything. I don't think so. So thanks for tuning in, and you'll be getting an email with the new times. It will be recorded, so you can watch it at your leisure as well. And we'll see you all next week. Okay, thank you.